Hello, welcome everybody. I guess the first participants have already joined the call. This live YouTube stream, which we're organizing as part of the Dutch Blockchain Week, will be about our company, Boosting Alpha, that writes trading algorithms on financial markets, including crypto, and is responsible for a lot of these developments. Thank you for joining to this call. Unfortunately, as part of the YouTube live stream, we do not have the possibility to share slides, so you will need to do it with this video and my voiceover. But thank you for joining. Maybe to start with a little bit what Boosting Alpha is about. So Boosting Alpha is basically a technology company which purely focuses 100% on building trading algos for investors. We don't bring them to market directly, so we always work together with other parties like the bots platform, like Beursflow, like some exchanges, we're working together with a party that sells our algorithms to hedge funds, etc. But our own focus is primarily on building these algorithms, testing these algorithms, and also building let's say, the underlying infrastructure to be able to operate these algorithms on the different exchanges. So we're also investing, for example, in efficient trading execution algorithms to make sure that the signals coming out of our trading bots can actually be processed very effectively. At the moment, we are with 10 people. Roughly half of them are focused on, let's say, I would call infrastructure and our own trading platform, and the other half is focused on building trading algorithms. And building trading algorithms, it's I would call it a sort of an art. It's not a we are testing a lot of different stuff, and only a small percentage of that stuff is actually coming to market, that we feel is good enough to be actually released into the market. So there's a lot of things that we actually do which do not lead to, let's say, successful algorithms. So it's all about testing new data that we could use as part of the algorithms, testing new algorithm types. That's basically part of our premise. So the areas we focus on is quantitative finance, which is also called quants, algorithmic trading. We are heavy users of artificial intelligence. And in terms of getting an edge into the markets, we are not using only financial data, but also we try to use a lot of times non-financial data. In the financial world, it's called alternative data. Basically means data that is something else than just price and volume data. Because in the end, if you look at about alpha in financial markets, it's basically it could be related to two things. Either you use data which nobody else has access to, or nobody else is using. So the alpha element could be in the data that you use, and it could be in the type of algorithms that you run. And on both areas, we are continuously searching to find new innovations. We have three founders of Boosting Alpha. One is more focused on finance, or coming from a finance background. One comes from consulting, and one from artificial intelligence. So we started our company in June 2018. We initially started with building algorithms for the US stock markets, and also the forex markets. And I think about two and a half years ago, when we first met the bots team from Haarlem, we started working with them even before the app was actually live, or was not even live in beta. But a couple of months before that, we started working with them because we felt the bots app had potential, and we thought it could become a nice partner for us to work together with. So together with a company called Algorithmic, we were actually the first to market with algorithms on the bots app. And for the first 6 months, I would say it was basically only Algorithmic and Boosting Alpha. And by now, obviously, the bots app has grown quite a lot. There's a lot of allocated capital on the platform, and there's a lot of other bot builders on the platform as well. I see that there are some questions being asked in the chat, so that's good. My colleague Sue is also online and she is already reacting on those questions, because doing the presentation and reacting to the questions is kind of difficult, but Sue is helping me out, so that's good. So we started in June 2018. So December 2019, we launched our first trading algo specifically for crypto on the bots platform. That was also the time that the bots platform went live in beta mode. And at the moment, we have about 55 different trading algorithms live under 5 different labels. We are also active on with a small number of trading bots on CryptoHopper, on Signally. We are working together with some other B2B parties to bring our algorithms to the markets. And we also launched our own crypto copy trading platform in October this year, which is still in beta at the moment. We hope to go live, we really live, let's say, on the 1st of January. So based on the responses from the beta launch, our developers team is actually working to improve a couple of things to make sure that when we go live, basically all the important stuff is part of that. So what is the real issue we are trying to solve basically with every trading algorithm? So every financial investment, basically, whether it's about equity, about raw materials, about Forex, or about crypto, you basically have a return and you have a risk, right? And the return divided by the risk is basically what financial experts call Sharpe ratio, or even a better Sortino ratio, where basically you only look at let's say the negative risk and not the positive risk. And what we are trying to do in a normal situation, like say if you would invest in a benchmark like I don't know, S&P 500, then Sharpe ratio would be let's say 1.0. So everything which is above 1, basically, it allows you to say that the algorithm that you built, the return risk ratio is better than if you would have invested in the Standard & Poor's index. So it's not always about return. It's also about the level of risk that you have taken while achieving that return. So, for example, I see a lot of people on Discord, for example, around the bots platform, always comparing with a HODL strategy. But a HODL strategy, basically, you're always invested 100% in a particular crypto. So yes, if that crypto goes up, obviously you could have a high return, but you also incurred the full risk of the crypto market. And the full risk of the crypto market, if you look back in the last 2-3 years, that was a drawdown of, let's say 80% from top to bottom, or even more, maybe sometimes even 90%, if you look at the location where we are right now. So yes, you've been able to get a lot of return, but you also took a lot of risk in getting that return. And what we hope to achieve with all of our algorithms is that return risk ratio is basically better than when you would have invested in a benchmark or in a HODL strategy, or etc. So that's basically the purpose of always look at return versus risk. And I think that explains a lot of things where sometimes new users of our trading bots are asking questions about, because they only look at the return part. And obviously that's very difficult to measure, because if you look at public investment funds that you can buy in a stock exchange, you will always see previous return, but never previous risk. They never publish the risk they've taken to achieve that return, because by taking more risk, you can easily get, I don't know, on an investment fund 30%, 40% per year, but you took much more risk to get there. So always look at return versus risk. So what we are trying to do, if you look at all the investment funds around the world, and there are some academic studies that look at it every year, roughly 95% of the investment funds around the world are not able to beat their benchmark. So only 5% are able to beat their benchmark. So in this financial world, there's a lot of investments going on. There's a lot of players, and there are a lot of people, hedge funds, investment funds, etc. But a lot of them, the majority of them, basically are not able to just beat the benchmark. And if you look at U.S. equities, for example, the last 10 years, the whole S&P 500 increase has been led primarily by tech, right? So if you would have invested in tech, you would have done better than S&P 500. But any other sector, you would have always done worse than the Standard & Poor's 500. So yeah, could you have predicted upfront that this whole tech increase would happen? Yes or no? So that's the difficulty with beating benchmarks. You do basically what it allows is you need to have some kind of predictive capability to be able to make that kind of judgments. So what we try to do basically with algorithms, because an algorithm can never forecast perfectly about the future, just like we humans cannot do that as well, right? So but what we try to do is find alpha factors in data. And that could be in price and volume data. That could also be in alternative data. So, for example, we have an innovation project right now on Twitter feeds. We have another innovation project right now on news data. We have an innovation project right now on looking at multiple crypto exchanges at the same time, and seeing if there are differences, what that difference tells us. So that there's a lot of things going on in this data world, and could also be in the algorithm part. But the biggest benefit can be achieved in the data part. So if you find data which gives you an edge, the data which other people are not using, for example, or which is more difficult to compile, and that's probably the reason why not a lot of people are using it. Then that could give you an edge in financial markets. Our position in the value chain. So what I mentioned, we are primarily active. We're basically a team of developers. We are primarily active in building these trading algorithms, making sure we have the infrastructure and also the supercomputers to actually be able to run that efficiently. And running efficiently also means dealing with all the exceptions, right? So, for example, in the crypto market, basically in every big decline or every big increase, we see exchange APIs going down, etc., etc. So there's also a lot of it's not only training when the sun shines, it's also being able to deal with events that happen when when big movements on the exchanges happen. So that's where we focus on, primarily on building the algorithms and the let's say the infrastructure. And how we do that is we use our own platform basically to develop algorithms, and that platform allows us to not only test algorithms on history, but we use exactly the same platform also for live trading. To be able to do that, we actually built our own platform. Why do I say that? Because we've previously, when we initially started, we looked at all kinds of other platforms that allows you to backtest, that allows you to live trade. But a lot of these platforms are either only backtesting or only live trading. But we've not seen a lot of platforms where you can use the same platform to actually both test on history and also live trade. And if you use separate platforms for that, that also makes, when you convert the code from the test environment to the live environment and you need to change it, basically, it creates another risk factor. Another risk factor that, an algorithm in a live situation will perform different than in a testing situation. So that's why we invested a lot of time in let's say, building our own platform, which we call the Moonline platform. And that allows us to backtest basically on any type of asset. So whether it's Forex, US equity, crypto, we could even mingle different asset classes if we wanted to. And that goes on different time frames. So the data that we use for historic backtesting, that could be, tick data, that could be 5-minute bars, could be 1-hour bars, 4-hour bars, daily bars. We could have algorithms that work on multiple time frames in parallel, basically. Yeah. So looking not only at, for example, looking at long-term trends on a 4-hour bar, but looking at short-term trends on a 5-minute bar. So we could mix different time frames in the same algorithm, basically. And that's basically all allowed by our Moonlight platform, which is basically allows us to code whatever we want and to import libraries whatever we want. So we specifically decided to go for a maximum flexibility platform that allows us, as coders, to build in there everything that we basically want to build in there. So what is important in backtesting? Because I see a lot of bot builders, and then they provide backtesting results. And if I look at the period on which they backtest, they only tested it in the bull period, right? And then obviously you get very good results. So what is important in backtesting is that we always backtest algorithms not only on good periods only, but also on bad periods. So that's the reason why we always, we basically use a sort of a standard data set from on crypto, for example, from 1st of January 2018 up until, let's say, the last month. Why do we do that? Because we know 2018 was a very terrible year for crypto. 2019 was a little bit, let's say, sideways, but a little bit up. 2020 was a good year. 2021 also started with a good year, but also a little bit sideways market. But we always want to test our algorithms, how they operate in different types of market sentiments. Because we know from history that algorithms can perform quite different in different types of market sentiments. So in the development of the algorithm, that's obviously very important to make sure it reacts in all of these different market environments. So, for example, right now we are building algorithms on crypto, and there we look at data from 2000 to 2021. So we're looking at 21 years of 5-minute bars in this case, which is a huge data file, which you can imagine. So backtesting an algorithm on 21 years of 5-minute bars, it's my gaming laptop is running on the backtest for 3 days or 4 days to actually backtest that period with that amount and volume of data. So it differs quite a lot, but it's always a good algorithm developer always tests its algorithm on different market sentiments, because everybody knows a particular trading algorithm might run well in a particular market sentiment, but not in another market sentiment. Then there's obviously the forward performance. So once you did backtesting, and the risk that we always have with backtesting is that you have overtraining. You can imagine if I build an algorithm, I backtest it on 2 years of crypto data, and it works like shit, and I change a couple of parameters, and it works, it works very good. Yeah, you could say, okay, I have a good algorithm, I put it live because I have good results, but that would not be satisfactory for me. Because if I only slightly change parameters and that makes a big impact in terms of negative results versus positive results, then I wouldn't call the algorithm stable, right? After you started the first backtest, the more you've tested the same algorithm, the more you've configured the data, let's say on that same time period, the more risk for overtraining that is, because you basically have been adapting the algorithm to perfectly fit with history. And we all know one thing for sure: history will never repeat itself in the future, right? So the way the asset prices have moved in the last 2-3 years will never repeat itself exactly the same in the future, because the way those prices have moved in the last 3 years is one out of billions or trillions of potential ways those prices could have moved. So you only see in that sense, a very limited data set. So one thing, and that's a lot about feeling and less about mathematics, is look for stability. So if I look for backtest results, and if I change stuff, etc., how stable is it? Because we don't want any algorithms where you just make slight changes and basically it goes down completely down. That says something about basically instability. And usually it's better to have an algorithm with a lower return, which is more stable, than an algorithm with a higher return, where there's a more risk for, let's say, unstable results. Then the next thing is what happens a lot in, let's say, professional hedge fund industry, that even after you develop the algorithm, you test it, you're pretty sure it's not overtrained, it works well. Typically, you put it in a quarantine period for a couple of months. Usually, hedge funds on stock markets, they typically take a period of 3 to 6 months. Bots takes, for example, 1 month. That quarantine period is basically the intent of the quarantine period is, does the algorithm perform on a live market within the same specs as we've seen in the backtesting? That's actually to check on the overtraining risk, because somebody has been modifying that algorithm based on historic testing. And just by the nature of modifying the algorithm, you basically already run the risk of overtraining. So overtraining risk cannot be, that's a big risk in financial markets, and you cannot reduce it to zero. It's always there. So you always want to, you can do things to reduce that risk, obviously, but it will never go away for 100%. And that's why the quarantine period is there, to actually test it in live and have it running in parallel with the live markets, to see, if the performance and if the working of the algorithm is the same in quarantine as what you've seen in the backtesting period. So if we look at the overall development process that we typically use, we typically start by universe selection. So when I start building an algorithm, on which universe do I want this algorithm to run? And a universe could be, for example, I want to run it on US equity, I want to run it on Forex, I want to run it on the top 10 crypto coins, or I only want to run it on Bitcoin, for example, because there is a lot of demand for traders to have an algorithm which only invests in Bitcoin. So that's what we call the universe selection. So the defining, let's say, the fixed list of assets that you actually want to trade and where the algorithm should work on. That universe selection primarily comes from demand, right? So where do we see the biggest demand? So for example, I'm working with some pension funds now on an ESG concept for environmental sustainability related investments, where there's a lot of demand, and how do you determine which stocks are sustainable and which ones are not? But then the universe is driven by basically customer demand. Then if we defined the universe, then we start with the strategy research and selection. What my experience there is, if you look at all these famous technical indicators, I think I tried basically all of them multiple times. And all of these technical indicators standalone basically don't work. I've never seen one of those technical indicators that you can find on the internet. I've never seen them work perfect, basically. So in reality, a lot of times we build our own technical indicators, or we design them ourselves, or we combine a lot of things together, but using things like Bollinger Bands or SMAs, single moving averages, or all these kind of technical indicators. There have been actually academic studies done into the effectivity of all of these individual technical indicators, and most of them do not get higher than, let's say, 55% accuracy. So they could give you a little bit of a small edge, but it's not sufficient to build a profitable algorithm. Then you get to the strategy implementation, obviously, the coding and the backtesting, and we should not underestimate putting it live. So, for example, if we have a trading algorithm on Bitcoin, and let's say we have 10 million euros on it, and if you would place a 10 million euro order on Binance, you will immediately see in the order book, because in the order book on Binance, you will typically see, the largest orders being 100K, 200K. So if you would shoot in an order of 10 million, you will definitely draw attention in the order book. And you will definitely have an impact on pricing and volume at that point in time. So one of the things that is very important in the trading execution part is limiting the impact of your own orders on pricing, on volume, and being or staying under the radar, basically. That's not a part what should be what I've seen in a lot of parties I work with, is that they are not so advanced in that space, so to say. So that's definitely an area where, because in the auto execution, you could have an excellent algorithm, but you could still lose a lot of money in the auto execution if you don't get, the good pricing, the good volume, and your order is not going to be executed fast enough, for example. So there's a lot of benefit to be made in that order in a trading execution part. And we're actually doing a big innovation project right now with the university, with some people from the University of Maastricht, on building our own trading execution platform using the latest AI technologies to automatically determine, which order should we place when, given a particular signal from our trading algorithms. How should we process this volume on the exchange? How do we divide the quantities, etc. Then another part I would like to explain is the different types of backtesting engines. There's basically two top layers of backtesting engines. One is called vectorized backtesting, and the other one is event-driven backtesting. Most of the parties I've seen around me use vectorized backtesters. A vectorized backtesters, if you have a little bit of coding background, you basically have a pandas data frame and you run a particular operation on the data frame, and it calculates, the 3 or 4 years of history in 5 seconds or 6 seconds. So that's typically a vectorized backtester. We are not using that. We are using what we call event-driven backtesting. So how does that work? Our trading engine basically starts at a point in history. So let's say 1st of January 2018, and it adds a time bar. So let's say we run on 5-minute bars. It adds 5 minutes each time, and each time it adds this time bar, it looks into the code, what it needs to execute at that point in time. That allows us to build much more complex trading algorithms. So basically, in a vectorized backtester, you're limited to whatever you can build in a pandas data frame, let's say, operation, which is pretty limited, right? It's usually limited to some technical indicators or that kind of stuff. But what we can build in an event-driven backtester is basically whatever we can build in code. So the actual trading strategy code in our case might be 2,000 lines of code, which you will never be able to fit in a vectorized backtester. The difficulty, though, with event-driven backtesting, the backtest could actually run a couple of days. So the amount of backtesting time that is required to actually run this algorithm over all of this data takes much more time than vectorized backtesting. So usually event-driven backtesters are used by the more, let's say, advanced trading algorithm builders. But I would say 99% of the people use these vectorized backtesters. Those are also the type of backtesters that you will find on open source libraries on GitLab. Those are more the simple backtesters. What kind of strategies? Obviously, I cannot, disclose the explicit strategies that we are using in any of the algorithms that we have live. So maybe to explain some strategies that are more, let's say, famous or more advanced. So one of the big ones that was actually invented 20 years ago by people at Morgan Stanley is a concept called pairs trading. And pairs trading, basically, you take two assets. Could also be three assets, but most of the time people take two assets. You take two assets which you know they have a big chance of always moving together. That could be very basic, right? So, for example, Shell, for example, has equity listed in Amsterdam on the exchange and also in London. You know the underlying value is exactly the same because it's a Shell company, right? So the underlying value is exactly the same. But in London, it's notated in British pounds, and in Amsterdam, it's notated in euro. So if you see a difference between the two prices, when you take into account currency conversion, you can basically do, I don't know, 50,000 trades per day, and each time earn this 1 cent or 2 cent difference, and then you can build a successful algorithm. That's called high frequency trading. And that requires you to be very close to the exchange, to have low latency times. That also requires you to have basically very low trading fees, because if you're talking about differences of 1, 2, or 5 euro cents, you basically need very low trading fees to benefit from those type of deviations. But that concept, pairs trading, can also be used in assets that look similar but are not exactly the same. So, for example, in the crypto market, would people say that Bitcoin and Ether always move in the same direction? Well, I know that's not the case, because Ether has been slowly climbing upwards in the last couple of months, while Bitcoin has been more stable sometimes. But there are assets in the crypto world where you could consider, trying a pairs trading, because you know that these particular assets always more or less move together. And then you can assume that if they moved out of band, that sometime during the future they will get back to each other, right? And that's why you trade on with pairs trading. You basically see a deviation in pricing, and you predict that deviation after a period of time will disappear, and that they will get closer to each other again. So pairs trading is a low risk concept. In the pension world, for example, pensions like what we call market neutral strategies, and those are basically used primarily on pairs trading, where if you have these two assets, so for example Shell Amsterdam, Shell London, then you go long in one asset, you go short in the other asset for the same amount of money. So basically, you're neutral to the market. That's why they call it market neutral. So market neutral trading algorithms are usually based on pairs trading. And in equity markets nowadays, I think 20 years ago when Morgan Stanley invented this concept, you could make 20-30% per year with a pairs trading algorithm without a lot of risk, because the drawdown of these strategies, because you are basically you're market neutral, right? So the performance is independent on whether the market goes up or down. So 20 years ago, you could probably get between 20 and 30% per year. Nowadays, pairs trading is basically used by all the big hedge funds, all the big investment funds, and you would be lucky if you get 6-7% per year with a strategy like that. And it's very dependent on trading fees and low latencies to the exchange. Unless you obviously look for pairs which are less closely related to each other, but you still expect them to move in a coherent way. Another strategy which is used a lot is the Bollinger Band strategy, and you probably have seen that, right? Where you draw, you have this price chart, and you draw bands. You have an upper band and a lower band. Usually, the upper band is drawn 2 times the standard deviation, and the lower band also 2 times standard deviation. And then the assumption is that prices will always remain within the band. So when they reach the bottom of the band, you could place a buy, and when they reach the the top of the upper band, then you could, say that the price goes down. Bollinger Band strategies are typically used a lot in the forex industry, so currencies. I've seen people use it also in crypto. I find it less attractive in crypto because the risk with a Bollinger Band strategy happens when the price doesn't stay within the band, but you get a breakout. That's what we call a breakout. And breakouts are very frequent in the crypto world. We've seen that last week, obviously, when the Bitcoin dived with, 15%. It dived out of the bands, basically. And in markets where those breakouts happen very frequently, Bollinger Band algorithms tend to underperform or perform negatively. So usually in the crypto world, I haven't seen a lot of crypto is too volatile, and you have too many breakouts for a Bollinger Band strategy to be operational. But in the currency world, so forex, where the prices are more or less more stable, that's a more used, let's say, trading strategy. Candlestick patterns, everybody knows them, Japanese candlesticks. There's a lot of theories around, if you have three candles, next to each other, and they form a top pattern or a bottom pattern or a head and shoulders, or what that actually would mean. There have been academic studies looking at previous performance of candlestick strategies, and none of them have achieved a high accuracy. And most of the candlestick patterns that do have a little bit higher accuracy do not occur a lot. So you might only get one or two or maybe three trading signals in a year with that particular pattern. And when those happen, you might have an accuracy of 58 or 59%, but they don't occur a lot. So most of the patterns that really occur a lot, like 3 or 4 times per day, those typically are the ones which do not have a high accuracy and would not work well in any trading algorithm. The same applies for moving averages crossovers. So where you have, for example, a moving average, a 21 period moving average and a 55 period moving average, and you're looking at where those moving average cross each other. Some people call that trend following algorithms, for example. Those can work well for some time. Again, unless you have, let's say, breakouts. My experience is that if you test these over longer periods of times, they will tend not to work very, very well. This was a little bit what I wanted to discuss. Right now we have a big project ongoing with the Einstein telescope project, which is a big project around gravitational wave detection. And what we're trying to do there is leverage techniques that the physics people and the physics professors in the gravitational wave detection world use there, and to see whether we can actually use them in financial markets. So one of the things we are doing there, for example, in gravitational wave detection, they are using, they have 4 detectors around the world. So one in Japan, 2 in the US, 1 in Italy. And they're using the sensor data from these 4 telescopes in parallel to reduce noise. And that's one of the things we are building right now and piloting right now. So we took, the 4 biggest crypto exchanges. We get, their live pricing feeds, the order book, tick data. And what we're trying to do, so if we combine the data from these 4 different sources, would we be able to reduce the local noise of an exchange, right? So each of the exchanges has their own local noise and their own, developments. So if we combine the data from 4 different exchanges, do we get a higher resolution picture of what's happening in the market, which basically gives us more accurate data than, when you would only have used data from Binance, for example. That's one of the things we are exploring. The other thing where we want to explore with the Einstein telescope is basically these physics guys are looking for things that happen in space, right? So binary neutron stars that collide, or black holes that explode, and stuff like that, and even the what they call in Dutch the Oerknal, so the existence of space basically. But a lot of these phenomena they've never seen before. They've never seen that in the signal. They want to find it, but they've never seen the real signal coming in the telescopes. So in theory, they don't even know what they're looking for. So how can you search for these phenomena? You don't know how it looks like in the data, but you do know what you are looking for in space, and that's what they built techniques around it, what they called unmodeled searches. And one of the things we are looking for is, can we use the techniques developed for this unmodeled search space to also apply that in financial markets? Because that's the other way, right? We are looking for patterns, but we are not always exactly sure what we are looking for, right? How does that pattern actually look like then? Because there's a lot of theories like how this pattern would look like these Bollinger Bands, technical indicators, and all that kind of stuff. But we also know that a lot of these things do not really work well. So the actual thing that we are looking for could be a lot different. And that's a lot of things we are building, and usually takes a lot of coding effort to actually build stuff before you can even test it. So we spend a lot of coding work to build stuff, which we are not sure yet upfront whether it will actually work. Because you can only test it after you've built it. So that's a little bit the background of what we do. So our task is not that nice, because a lot of the time we spend a lot of work on things that in the end will not work. And once every time we find something where we think, okay, this is stable enough, this is nice, this works, this has some form of alpha, and then we can publish it in our network on one of the platforms where we operate on, or on our own website. But but a lot of the effort is actually worthless because it doesn't turn into anything. I see my colleague Xu has already answered a lot of questions. Let me see if there are still questions open. Maybe to quickly go check some of these questions. Okay, I see a question here. What is the difference between positive and negative risk? So basically, if you calculate standard deviation, that would be the standard way of calculating, let's say, the risk factor. So the positive risk. So suppose you have a long algorithm, and the Bitcoin price jumps with 10%. That volatility is called positive volatility, because it's in your benefit, right? And when you have a long algorithm and the Bitcoin drops for 10%, that's called negative volatility. So a Sharpe ratio, when you calculate a Sharpe ratio, it doesn't differentiate between positive volatility and negative volatility. So basically, it calculates the total of both and sees that as the risk, while the Sortino ratio only takes into account the negative volatility. Because ultimately, the positive volatility we do not worry about, right? Because it's always in our benefit. So we are only worried about the negative volatility. And what we've seen in a lot of algorithms that we build, because I think we are quite good in building those algorithms, is that the algorithm makes sure that the negative volatility is much lower than the positive volatility. Because the positive volatility is positive for us, and the negative volatility is negative. And that we put in the code fragments to limit the negative volatility. So what we typically see in our algorithms when we test them, that, for example, the Sharpe ratio is 1.5, and the Sortino ratio is 2.5. But that's exactly what we want to establish, because the Sortino ratio takes into account negative risk or negative volatility only, while the Sharpe ratio takes into account both the positive and the negative volatility. Benchmark. Yeah, that's a good one. What benchmark to use for crypto? So in the US equity market, that was very simple because we always used the S&P 500 as the benchmark. And then the question was, can we beat the S&P 500? The benchmark in the crypto world is obviously much more difficult. You could say, I take the Bitcoin as a benchmark, but the Bitcoin is also not representative of the whole market. And if you have a multi-coin algorithm which trades in 10 different coins, then using the Bitcoin as a benchmark is also not, it doesn't say that much. So what we are basically have built in our system is that we basically benchmark against, let's say, a zero risk-free rate, because there is basically no benchmark or no apparent benchmark that we can use in the crypto world. But that can be different for other markets, of course. In a single coin algorithm, so if we would build an algorithm purely on the Bitcoin, that will be a little bit more easy then, because then you could take the Bitcoin as a reference. Yeah. But the benchmark question is more difficult in crypto. Yep. Let's see. Some other questions. Yep. Yeah, why 5 minutes bars? So somebody is asking, crypto only exists for 13 years and only 9 years of data. Yeah, why do we take 1st of January 2018 as a starting point? Because the period before that was only a bull period. So if we include that in the backtesting, you will get very high results, basically on average, which is nice to show to clients, but it's also kind of, faking yourself a little bit, because that the period before 2018 will never return again, or the chances are high that it will never return again. So yeah, it's basically fooling yourself if you take that period, and because that period is not really representative for the future. So why 5 minute bars? Well, what you see, for example, on the bots platform is that of these 55 algorithms, some of them are running on 4-hour bars, some of them are running on 1-hour bars, some of them daily bars or 2-week bars or 5 minute bars. Because different algorithms work different on different time bars. I could have an algorithm running very well on 4-hour bars, but if I run it on 5 minute bars, it wouldn't work. And the other way around. In general, if you would go to the higher frequency time bars, like a 5 minute bars, your algorithm will trade much more than if you are trading on a 4-hour time bar, right? And an algorithm that works on 4-hour time bars or daily time bars would be more focused on the long-term trend than an algorithm running on a 5 minute time bar, which will be much more focused on short-term deviations. You should also relate that to the trading fees, right? Because the trading fees in crypto are usually quite high if you compare it to equity markets. Also differs on the platform, right? So on bots, it's, for example, 0.2% per trade. That makes it a little bit more difficult to build algorithms on 5 minute bars, because by essence, you're trading much more. So that means you will also incur more fees, trading fees. And that means you need to find an alpha factor on that 5 minute trading bar, which is able to at least compensate for those trading fees, and obviously still lead to a big return. Without trading fees, life would be easy, right? If I would backtest an algorithm without trading fees, then it's probably very easy to build an algorithm that works well. But in reality, there are trading fees, and that's what we need to encounter in all of our backtesting, obviously. And the shorter the time frame, the higher the impact, basically, of trading fees. So the longer the time frame, the 4-hour bars, the daily bars, which trade more on the long term. So basically, you trade less. So the longer the time bar, on average, the higher the fees. but also the higher the risk. If you can imagine, if you trade on 5-minute bars and you trade more frequently, that also means you can exit the market more frequently. So that means the drawdown typically is also lower. So if we go to lower time frames like 5 minutes or even 1-minute bars or tick bars, those are basically algorithms which have less risk, but it's also more difficult to generate returns because you incur much more fees. And if you go to longer time frames, the risk increases because you are in the market for a longer period of time, but also the potential return rises. So generally, what you will see is that the higher, if you're looking for higher return, it means higher risk. Also, there is a straight line with going for longer time frames. Okay, let's see. Any other questions? Yeah, somebody's saying use a reverse to the mean strategy if you want stability. Yeah, that's correct. Some questions. What are your thoughts about the bot's performance during the last month? So our bot's performance in November, I published on the Discord channel on bots. I would say that was not super B. November was quite a difficult month, not only for our bots, by the way, because I also saw some of the other bot developers publishing their November charts. And at least what I saw from that is that everybody had the same issues. And that's obviously because November was quite, to predict the direction of the market was quite difficult for us humans, but also for the bots then. So that was a more difficult market. Let's see. Well, the high risk, medium risk, low risk bots, I think you refer to the risk factor that the bots app is calculating, which I'm not sure is a very good calculation, to be honest. We do have our own, let's say, assessment of high risk, medium risk, and low risk, because we also have a low risk, medium risk, and high risk crypto fund, which we are launching to the market to some other parties, some other B2B parties. And there we see a clear, and each of these funds is powered by a collection of our algorithms. So, for example, there we have 10 low-risk algorithms powering the low-risk fund, 10 medium-risk fund, 10 high-risk algorithms powering the high-risk fund. And there we see in the historic results a clear diversion of returns and risks between high-risk, medium-risk, and low-risk fund, just like you would have expected that, basically. So if I look to the way we have assessed our own bots in terms of risk, that looks to work quite good. But the way bots is calculating it, I don't know what calculation they are using. And I've seen a lot of comments on bots about this as well. So I'm not sure whether their calculation is that advanced to automatically be able to find that risk factor. But in general, on crypto, because volatility in crypto is high, generally, I would say crypto algorithms are always much higher risk than if you go to US equity or Forex, for example. Yeah. Are algorithms improving themselves, e.g. on the bots platform, or are they stable in production? Of the 55 algorithms we have live, I would say about 40 or 45 are not learning automatically. But we do have now, I think, about 12 of them live, which have auto-learning capability. So basically, they learn, they periodically retrain the machine learning algorithm. We are working on a number of new algorithms right now, which are also auto-learning. So we do have some machine learning driven algorithms. I have to say I'm not super convinced yet that will give a better result. The ones that we have live now are good, but I've done a lot of tests with its auto learning, and it's not. I'm not superly convinced that it is better than more, let's say, the stable algorithms. Yeah, it looks like a lot of bots are sleeping in past, not last weekend. That basically has to do with the return fees equation, right? A lot of our bots, I would say, on average, trade about 2, maybe 3, maybe 4 times per month. We've seen that in all of our testing that is a little bit the optimum space. If you want to compare returns with risk and also with the fees that are incurred. Yes, I am aware that there's a lot of bots on the bots platform which trade much more, and I have them also in my app, but I also see the impact of that, basically meaning that they lose money. So trading a lot is might be good for the fees for the bot developers, but it's not good, I think, for the users. And I've yet to see any bot that trade much more than this 2, 3, or 4 times per month, which also has a good manages to combine it with a good performance. Yep, that's about it. Yep, I see no new questions, so I hope this session was worthwhile for everybody, and I managed to actually spend about 60 minutes on this. I thought initially it would be done within 30 minutes probably, but I want to thank everybody for your presence and your attention. And if you have any questions, then just send us an email on info@boostingalpha.com, and I'm sure one of our team members will pick up those questions. Thank you for your attention and presence. Bye.